The economy is in a very weird place right now. I'm sure all of you are aware of this. We're still trying to recover from the pandemic. We're trying to actually experience some growth as things open back up, but we're still having to deal with a lot of the fallout effects of all the money printing we did, all the money spending that we've done, which is leading to inflation, rising interest rates. A lot of people don't even want to work anymore. There's just a lot of challenges going on, a lot of things that could potentially send us right back into recession if we don't get the economy back under control. As a result, though, the stock market has been very volatile, and I gotta admit, I kind of like it. I've seen a lot of stocks getting hammered, a lot of prices going down, and bank stocks in particular have actually been getting hit very hard in recent months, which is not only leaving their valuations very low and attractive, but it's also rising their dividend yields. And as a result, I've been getting a lot of questions in my videos asking me, how do I feel about bank stocks in particular and the overall financial sector? And do I think that bank stocks are a buy right now on this dip, or are they still just a little bit too risky to be going near them considering all the challenges that are going on with the economy and everything else? So I'm going to try to give my opinion on all of that as best I can. I'll let you know exactly what I'm doing myself, what I own, what I'm buying in terms of bank stocks and financial stocks in particular. But it's going to be a fun one. I hope you guys enjoy it. Let's go ahead and get started. What's up, everyone? My name is Ale. Welcome back to my world of stocks. All right, let's go ahead and just start here. The way I'm going to structure this is we'll list off some pros and cons, some benefits, but also some risks to owning bank stocks, and we'll talk a little bit about some other things as we go through the list. We'll broaden the reach a bit. We'll talk a little bit about the economy, the financial sector, and a few other things. And of course, I'll let you know what I own and what I plan to own and all that kind of stuff. So let's just go ahead and dive straight into this. Okay, now to start things off here, one con that I would definitely say about owning bank stocks is the short-term volatility. These stocks can be so heavily influenced by the economy, by policymakers, and of course consumers, which makes them pretty hard to predict over the short term. Anything can kind of happen in the short term time span, and it can really influence these stocks. For example, during the 2020 pandemic and the resulting lockdowns, financial stocks were actually some of the worst hit. Now, despite the S&P 500 climbing by 16% in 2020, all of the five big banks actually saw huge drops. Chase fell by 8%, Bank of America fell by 13%, both Citigroup and US Bank fell over 20%, Wells Fargo lost close to half of its entire value, and you have to keep in mind, this was after a large recovery at the end of the year for most stocks, these included, but they were still down by large amounts just because they had fallen by so much during that year. Of course, bigger recoveries were seen the year after in 2021 as the economy opened back up. But here in 2022, they are falling once again. From their 52-week highs, Chase is down about a quarter of its value. Bank of America is down closer to 30%. You've got Wells Fargo that is down 25% from their 52-week high, and they're also negative over the past 5 years. You've got Citigroup down 36%, and it's also negative in the past 5 years. US Bank is down about a fifth of its value while also being about flat in the past 5 years. And a big reason why is because of the current state of the economy, which banks are highly sensitive to. And there's a fear right now that the current rise of inflation and the rising interest rates to combat that inflation is going to hurt consumers and snowball us into a recession. As you probably know, consumer spending makes up about 70% of the entire US economy. And as you can see on this chart, the 2020 lockdowns sent consumer spending crashing down into the ground, which resulted in recession and a stock market crash. Now, here in 2022, it's of course rebounding to new all-time highs because things have opened back up, but something else that is also at an all-time high right now that you should keep an eye on is our inflation rate because of all the money that we've created in our insane spending sprees. I mean, here's a chart of our M2 money supply, and you can see how it skyrocketed following 2020. In large part, this was due to the more than $7 trillion in federal response money to the pandemic. And the results of that is that our inflation rate is now at the highest levels that we've seen in decades. Now, before we go any further, we do actually have to add this one too to the pros section aside from just the con section, because while it is true that high inflation means that the price of goods goes up, which means that consumers' money is worth less than it used to be, and that makes it harder for them to make purchases, which ends up destroying the economy and sending us into recession, which ends up hurting banks because people don't pay back their loans during recessions, or at least a lot of them, and they also avoid larger extravagant purchases that are typically financed through banks and allow them to collect interest. But while all of that is true in the cons section, it is also true that rising inflation leads to higher interest rates to combat that inflation, and higher interest rates can help big banks collect more money on their loans and the credit that they give out. So it kind of depends on how extreme the inflation and the rising interest rates are, because a healthy small amount can actually help banks, but a really high extreme amount will end up destroying them. And there's no doubt about that. People will try to BS that, but in the end, it'll destroy them. That, at least, okay, what that's my opinion. Anyway, while we're on the subject of things that are both good and bad for banks, though, I might as well throw in another item here into the pros category, and that's that because of the volatile short-term stock prices and how much they've been getting hurt, the result is also that most banks are currently trading at some really cheap valuations while also paying out some very attractive dividends, both of which could help set them up for large recoveries over the long term, or especially if the economy starts to improve. For example, when you look at all the different sectors right now and how their prices compare to historical averages, well, the finance sector is actually looking like one of the cheapest, if not the cheapest. This chart here shows the horizontal line as the average PE ratio over the past 10 years, with the circle dot as the current PE, and you can see that financials are dramatically lower than the average compared to all the other sectors. And of course, you have technology there, which is a lot higher because of the lockdowns and the resulting rise of internet usage. So a lot of people have been buying up, these tech company stocks. And then you also have consumer discretionary very high because of all the panic buying and the perceived safety of that sector. But at this point, I would just kind of focus here on financials for a second. They look very cheap, which is also leaving them with some very attractive dividends. In fact, out of large cap companies spread across 11 different sectors, financials currently have the fifth largest dividend yields. Another pro I would say about banks too is that they've largely learned from the lessons of the '08 financial crisis, and they've implemented huge changes to lower their risk. Not only have the largest US banks increased their capital relative to the risk-weighted assets by nearly 100% since then, but they've also tightened their underwriting and borrowing standards while also building closer relationships with the government on policy and compliance. For example, they weren't even really a very big risk during the 2020 pandemic. If anything, they were actually beneficial to the economy and helped it recover by extending credit, deferring collections, and helping administer government programs. And while sales may not be growing at high rates right now, banks have done a pretty good job of expanding their profits over the years while also buying back stock. Yet their prices don't really reflect that in the stock. Here's another chart from davisfunds.com, and you can see that the earnings per share ratio of the financial index to the S&P 500 index has been climbing for years, yet the actual stock price ratio has been lagging behind it for nearly a decade while the gap continues to grow larger. Now, this might suggest that at some point, investors realize that there's value in the financial sector and they start to buy it up, and then that starts to close the gap at just like it did many years ago, and that would obviously send the stock prices rising. And so when you look at it from these standpoints, bank stocks and financial stocks in general might be a great addition to any portfolio right now. However, one last risk that I haven't mentioned yet is perhaps the biggest one of all, and that is rising competition of smaller fintech companies that are trying to disrupt the entire industry. Companies like SoFi or Robinhood, or even cryptocurrencies like Bitcoin and Ethereum. You get the idea. But while I do think that all of those type of things pose a lot of risk, I also think that there are plenty of smart ways to mitigate and lower all of these different risks that we've been talking about in the video, and that's by making some smart investment decisions. So I'm going to finish up the video now by just quickly running through some tips that I have for you guys, as well as letting you know what I'm personally invested in myself too, just so that we have full transparency. But first tip here, I'm going to say that you should invest in quality. You want a company that has proven that they can withstand economic downturns, is a heavy player in their respective market, and that has a stable stock with decent value and maybe even a nice dividend if that's something that you enjoy collecting too. And for me, that company in the banking and finance sector, that's always been JP Morgan Chase, ticker symbol JPM. Out of all the banks in America, Chase controls the most market share by deposits and the most market share by assets. They've also proven that their business can withstand economic downturns because during the '08 financial crisis, they actually acquired failed banks and they continue to give out loans in order to help the economy. Obviously, that's a more positive look at the things that Chase did and how they behaved. And there's certainly many things that we could criticize them on. But overall, I think Chase performed better than most other banks during one of the biggest disasters of our lifetime. And speaking of, huge disasters, even during the 2020 pandemic, Chase ran their own stress test that was even stricter than the Federal Reserve's test, and they easily passed it. That test, by the way, it assumed that there would be a gigantic recession of 35%, and Chase was still able to pass that. For context, I think the Federal Reserve only tests for a recession of like less than 10%. So it was a much stricter test that Chase ran. Plus, when you look at the stock, it's also remained more stable than most other banks too. At positive 57%, it's right up there close to Bank of America and the S&P 500, while the others are much lower or actually negative over the past 5 years. And yet, despite the stock performing better than most other banks, JP Morgan's valuation is actually still about the same as the sector, while also giving you one of the nicest growth-oriented dividends in the market, with a yield that is still above 3%, is higher than both Bank of America and Wells Fargo, and it's got some of the best growth metrics that you could ask for, with nearly a decade of consecutive growth, a double-digit growth rate of about 15%, and a super low payout ratio of less than 30%. Again, that's just me though. I like JPM, but you can like a different stock for your own reasons. Tip number 2 though, invest in non-complacent companies. One of the best ways to fight off disruption is to own a company that actually implements the new technologies into their own business and uses their large size to their advantage. In the case of my only bank stock being Chase, well, they've been doing a great job of this for years. More recently, they actually launched a new online bank in the UK that has already surpassed over 500,000 customers with over $10 billion in deposits. Not only does that give them exposure to the UK, but it was essentially a test pilot before they start expanding it out to other countries around the world as well. Plus, they've been investing in blockchain technology for years, which is probably going to be the main staple of finance over the long term. But honestly, another simple way to mitigate the risk from rising fintech and other disruption is to just own a little bit of it yourself. I actually own a very small amount of a few different things. I own a small amount of Visa, which gives me exposure to the digital and card-based transactions markets as the world leader in credit card payments network. And they also give me exposure to crypto and blockchain technologies as well, because they've been investing heavily in both of those for years and have even launched new cards that are linked to cryptocurrencies. And then if I want to take a bigger gamble here with a lot more risk, well, I also own very tiny positions in Robinhood, which gives me exposure to mobile investing as well as other digital finance features. And I even own some small amounts of cryptocurrencies like Bitcoin and Ethereum just for that added exposure to crypto. And that really leaves me with the final tip of the video, which I think is perhaps the most important of all, and that is to only invest a reasonable amount of money here in this area. Bank stocks can be hard to invest in, and many fintech companies and, of course, cryptocurrencies can carry a lot of risk too. But if you know where to look, you can find some good deals out there, some good value, and even some attractive dividends. And like I said, for me personally, Chase would be that staple stock that I enjoy owning long term. It's that staple bank stock. And then I sprinkle on a few other financial companies here and there, Visa, Robinhood, cryptocurrencies that carry a bit more risk and things like that. But overall, when I put the whole picture together, all of these financial related assets that I own here, it only makes up less than 5% of my portfolio. And I know that may sound very low to a lot of you, and especially if you're very knowledgeable about the financial sector and you know what you're doing, you know what to look for, you know the risk, and you really enjoy owning bank stocks and other finance and fintech companies and things like that, then yeah, you might have a much higher percent of your portfolio allocated to that area, and that's totally fine. In fact, I always preach that you should invest heavier in the areas that you understand more and that you feel more comfortable with. But for me, the financial sector has always been one that I've never felt super comfortable with, and I know that the average person doesn't understand a lot of these fintech companies and a lot of these technologies and with cryptocurrencies and blockchains and all that kind of stuff. So for those people, I do think that limiting your exposure to that sector makes sense. For me personally, it helps me sleep really well at night knowing that only 5% of my portfolio goes to that area. If all of those companies went to zero, if all those assets went to zero, in the absolute worst case scenario, that's only 5% of my portfolio. And realistically, I don't expect Chase or Visa to go down to zero. Those are market leaders. Those are very well established companies. And Chase makes up like 3% of that 5%. And then Visa makes up like another 1%. So that's already 4% there. I only have less than 1% in the riskier ones like Robinhood and cryptocurrencies and things like that. And it is much less than 1%. So I feel very comfortable. I sleep good at night knowing that I'm not overly exposed to it, but I do still have some exposure to that area. And personally, if you ask me, are bank stocks a buy right now? Well, I do actually think that they're a buy, but for me personally, it's just Chase. That's the one that I like. The other ones, I'm not really that interested in. I personally wouldn't buy those. But maybe you guys find something there that you like in Bank of America or US Bank or Citigroup or some other company. But for me, Chase, I think Chase is at an attractive price right now. I do like it. And I do own it, and it's mixing with some other stocks and assets, and overall the complete picture just kind of makes sense for me. So anyway, those are my thoughts. Those are my feelings on everything that's going on here in terms of finance sector and bank stocks and all those different things. But let me know if you agree or disagree with anything I said. I'd love to hear your comments down below. It was a little bit of a difficult video to explain all my different feelings and opinions without making it insanely long of a video, but I hope I did a good job for you. Thank you for watching, and I'll try to respond to comments down below, and I will catch you in the next video. Take care. Bye-bye.